Losing a husband or a wife is one of the hardest things a person ever goes through. And for most widows and widowers, the very last thing on their mind is taxes. But here's what almost nobody tells them. The year after your spouse passes away, you can end up owing more in taxes on the exact same income than you ever did as a couple. It's not a scam, and it's not a mistake on your tax return. It's built right into the tax code. Financial planners have a nickname for it: the widow's tax. In the next few minutes, I'll walk you through, in plain English, exactly why this happens, the 4 ways it can hit your wallet, your tax brackets, your Medicare premium, Social Security, and required withdrawals, and a simple plan every couple should put in place before they ever need it. I'm Ray. If you're married, or you know someone who recently lost a spouse, please watch this one all the way through. Quick and important. I'm not a CPA, attorney, or financial advisor, and this is education, not tax or financial advice. The numbers I'll mention are current federal figures for 2026. They're adjusted every year, so always check IRS.gov, SSA.gov, and Medicare.gov for the current amounts, and talk to a licensed professional about your own situation. So what actually causes this? It's not a new tax. It's a change in something called your filing status. While you're married, you and your spouse usually file as married filing jointly. One return, combined income, combined deductions. The IRS treats you, financially, as one unit. The year your spouse passes away, you can usually still file jointly one last time. But starting the following year, in most cases, you become a single filer. There's one exception worth knowing. If you have a dependent child living with you, you may qualify for qualifying surviving spouse status, which keeps the joint tax rates for up to 2 more years. But for most retirees 65 and older, the kids are grown and out of the house. So that exception doesn't apply, and the switch to single happens fast. And that one word, single, is what quietly changes everything. Let's look at risk number 1. Risk number 1. Your standard deduction and your tax brackets shrink, roughly in half. Here's a simple, current example. For 2026, a married couple filing jointly gets a standard deduction of about $32,200, plus extra amounts if you're 65 or older. A single filer gets about $16,100, close to half. Tax brackets work the same way. The income ranges where you pay 10%, 12%, 22%, and so on are roughly twice as wide for a married couple as they are for a single person. So picture this. A couple has retirement income, pensions, investments, required withdrawals that comfortably sat in the 12% bracket while they filed jointly. After one spouse passes, the survivor reports that same kind of income, but now it's squeezed into the same dollar amounts spread across half the room. A lot of that income can get pushed up into the 22%, even 24% bracket, without a single dollar of new income. That's risk 1. Now let's talk about something that surprises people even more: Medicare. Risk number 2 is called IRMAA. It stands for Income-Related Monthly Adjustment Amount, and it's a surcharge on top of your normal Medicare Part B and Part D premiums if your income is above a certain level. Just like tax brackets, the IRMAA income thresholds for a married couple are roughly double the thresholds for a single person. So a household income that was comfortably under the limit as a couple can suddenly be over the limit for a surviving spouse filing single, even though total household income just went down when one income source disappeared. And here's the part that catches people off guard. Medicare looks at your income from 2 years ago to set this year's premium. So a widow or widower can get hit with a higher Medicare premium based on income from when their spouse was still alive and they were still filing jointly. Now here's some good news. A real, legal option. The death of a spouse counts as a life-changing event under Social Security's rules. That means you can file Form SSA 44 to ask for your IRMAA to be reconsidered right away based on your current, lower income, instead of waiting 2 years for it to catch up. It's worth knowing that form exists. That's the tax and Medicare side. But what about the Social Security check itself? That one trips people up too. Risk number 3 is a misunderstanding about Social Security, and it makes the whole situation worse. When a husband and wife both collect Social Security, many people assume that after one passes away, the survivor simply keeps both checks. That's not how it works. Social Security pays the larger of the 2 benefits, not both combined. So if your spouse's benefit was the larger one, you can step up to that amount. But the smaller benefit simply stops. That means total household Social Security income drops. Here's the cruel part. Other income often doesn't drop at all. Pensions, investment income, required retirement account withdrawals, those can stay exactly the same. So the surviving spouse can end up with less Social Security income, but the same total taxable income, now taxed at single rates. Less coming in, more going out to the IRS. That's the heart of the widow's tax. And there's one more piece that doesn't pause for grief either. Risk number 4. Required minimum distributions, RMDs, from retirement accounts keep going, on schedule, no matter what's happening in your life. If your spouse had an IRA or 401k, a surviving spouse can usually roll it into their own retirement account. That's often the right move. But it also means those required withdrawals continue, sometimes on a combined, larger balance. Every one of those withdrawal dollars is taxable income, and now it's taxed on a single return, in those narrower brackets we just talked about. The withdrawal didn't get bigger because you wanted more money, it's just required. But the tax bill on it can look very different than it did last year. So, smaller standard deduction, narrower brackets, a possible Medicare surcharge, a Social Security check that didn't double, and required withdrawals that don't pause. 4 pieces, one bigger tax bill. Let me show you how this actually played out for someone Richard and Martha know. Richard and Martha have a close friend named Carol. Her husband Frank passed away early last year. Carol wasn't thinking about tax brackets, she was grieving. And nobody warned her about any of this. About a year later, when she sat down to file her taxes as a single person for the first time in over 40 years, the bill was noticeably higher than what she and Frank used to pay together, even though her income had actually gone down since Frank's pension income stopped. Carol called Martha, confused and a little scared. Martha didn't have answers, but she remembered something from one of our earlier videos and suggested Carol sit down with a CPA before just paying whatever the software told her to pay. The CPA couldn't make the higher bracket disappear. That part is just how the law works. But she did catch one thing. Carol hadn't filed Form SSA 44 after Frank passed, so her Medicare premium was still based on old, higher joint income. Fixing that alone saved her real money every single month going forward. Carol's story isn't a tragedy with a perfect ending. The bracket squeeze is real, and there's no trick that erases it. But a little planning ahead of time and a quick conversation afterward made a real difference. So what should you actually do? Let's go through it. 5 calm steps. And notice that most of them happen before you ever need them, which is the whole point. Step 1. Talk about it while you're both here. Sit down together and walk through, in plain terms, what your tax picture would look like if one of you passed away. Most couples never do this, and it's the single biggest reason the widow's tax feels like a shock. Step 2. Review your retirement account beneficiaries and withdrawal strategy with a CPA or financial advisor. Sometimes spreading out withdrawals or converting some savings to a Roth account over several years can soften the bracket jump later. That's a real strategy conversation to have with a professional, not something to do on your own from a YouTube video. Step 3. Keep a simple folder. Account numbers, advisor contacts, where documents are, so the surviving spouse isn't searching for answers while grieving. Step 4. If you do lose a spouse, file Form SSA 44 for IRMAA reconsideration as soon as you're able, so your Medicare premium reflects your real current income instead of 2-year-old joint income. Step 5. See a CPA for that first tax year alone. Software can file the numbers, but a professional can spot the fixable pieces, like Carol's Medicare premium, that a program won't flag for you. None of this makes losing someone easier, but a little preparation means the tax system doesn't get to make it harder too. If this opened your eyes, or you know a widow or widower who could use it, hit subscribe and share it with them. I break down a retirement money topic every week. And tell me in the comments, did this surprise you, or has it already happened in your family? I read every one. Next time, we're staying on this same thread, the tax surprise that waits for every couple once required withdrawals kick in around age 73, even while both spouses are alive and healthy. It's one more number the IRS doesn't send you a warning letter about. Don't miss it. Take care of yourself, and take care of each other while you can. I'm Ray. See you in the next one.